Microsoft, Amazon, Google, and Meta have spent over $200 billion on AI infrastructure in the past 2 years. $200 billion, data centers, GPUs, energy infrastructure, networking equipment, massive capital expenditure to build the AI future. And what do they have to show for it? ChatGPT, Copilot, Gemini, tools that are impressive but not profitable at scale, products that cost billions to build and operate but don't generate revenue to justify the investment. The math doesn't work. The returns aren't there. And the billionaires know it. That's why Bill Gates reduced Microsoft by 55%. That's why Jeff Bezos sold $8.5 billion of Amazon. That's why insiders across big tech are liquidating while AI hype keeps stock prices elevated. They see the numbers. They know the revenue isn't coming. They know this is a bubble, and they're getting out before it pops. Let me show you exactly how much has been spent, what the returns look like, and why the AI bubble is deflating. Start with the spending. Microsoft's CapEx exploded from $15 billion in 2020 to over $50 billion in 2024. Almost entirely AI infrastructure. Data centers, NVIDIA GPUs at $30,000 each, hundreds of thousands. Energy infrastructure, cooling, networking, all for ChatGPT, Copilot, and Azure AI. Amazon's AWS CapEx, $35 billion in 2020 to over $55 billion in 2024. AI-driven. Building data centers, custom AI chips, energy capacity. Google spent over $40 billion in 2024 on CapEx. Much AI related. Infrastructure for Gemini. AI-enhanced search. Google Cloud AI capabilities. Meta allocated over $35 billion to infrastructure. AI research. Data centers. Zuckerberg betting AI will be core to future platforms. Added up. Microsoft, $50. Amazon, $55. Google, $40 buy. Meta, $35 buy. That's $180 billion in 1 year. Over 2 years, well past $200 billion from just these 4. Doesn't include Apple, NVIDIA, or AI startups. $200 billion, the largest coordinated capital expenditure in tech history. Larger than internet infrastructure in the 1990s, larger than mobile build-out in the 2000s, an unprecedented bet that AI will generate returns to justify investment. But the returns aren't there. Let me show you the revenue side because that's where the bubble becomes obvious. ChatGPT is the most successful AI product. OpenAI reports approximately $2 billion annual revenue from subscriptions and API access. 2 billion sounds impressive until you realize the cost structure. Running ChatGPT costs hundreds of millions yearly in compute. NVIDIA GPUs 24/7, energy bills tens of millions monthly. Margins are razor thin. And $2 billion doesn't justify Microsoft's $50 billion annual AI capex. Copilot, Microsoft's AI assistant integrated into Office, is priced at $30 per user monthly. Microsoft reports strong adoption, but hasn't disclosed numbers. Industry estimates suggest maybe 2 million subscribers. That's $60 million monthly revenue, $720 million annually, nowhere near the billions spent on infrastructure. Azure AI services generate revenue from enterprise customers using Microsoft's AI infrastructure. But this is competing with AWS and Google Cloud in a race to the bottom on pricing. Margins are compressed significantly. Revenue is growing, but not fast enough to cover the CapEx explosion. Microsoft's CFO has acknowledged that AI revenue growth is not yet matching the pace of infrastructure investment significantly. Najpierw by så det spåren, hans dinsodresan där ädne motsats så bosen då san. Corporate speak for we're spending way more than we're making. Amazon's AI story is similar. AWS offers AI services to enterprises. Amazon Bedrock, SageMaker, AI-powered analytics tools. But adoption has been slower than expected. Enterprises are cautious about AI spending given uncertain ROI. And the revenue from AI services isn't offsetting the infrastructure costs. Amazon's free cash flow actually declined 7% in recent quarters despite revenue growth because CapEx is consuming cash faster than operations generated. Google's Gemini is offered in various tiers, free for consumers, paid for enterprises. But Google hasn't disclosed meaningful revenue from Gemini. The AI features integrated into search haven't increased advertising revenue significantly. And Google Cloud's AI revenue, while growing, isn't material relative to the company's total revenue base or the spending required to support it. Meta's AI investments are even more speculative. AI features in Facebook and Instagram haven't directly monetized. AI research supports long-term product development but generates zero revenue today. Meta is spending billions on AI with no clear path to profitability from those investments in the near term. This is the revenue reality. Billions in spending, millions or low billions in revenue. The math doesn't work. And the billionaires selling their tech stocks know it. Now let me show you why the revenue isn't coming as fast as expected. First, AI costs are too high for mass adoption. ChatGPT Plus costs $20 per month. For many users, the value doesn't justify the cost. The free version has limitations that frustrate users. The paid version is useful, but not essential. Adoption has plateaued. OpenAI isn't getting the hockey stick growth that would justify billion-dollar valuations. Second, enterprise adoption is slow. Companies are testing AI but not deploying at scale. Why? Uncertain ROI, integration complexity, data privacy concerns, regulatory uncertainty. Most enterprises are running pilots, not production workloads. They're spending thousands, not millions. And until they scale up spending, the AI infrastructure built to serve them sits underutilized. Third, AI doesn't have a killer app yet. ChatGPT is impressive but not transformative for most businesses. Copilot is helpful but not essential. Gemini is interesting but not revenue generating. Compare this to previous technology waves. The internet had email, e-commerce, search, mobile had apps, social media, messaging. AI has chatbots and content generation, useful but not world-changing, not yet. Fourth, commoditization is happening faster than expected. When ChatGPT launched, it had a significant lead. Now there's Gemini, Claude, Llama, and dozens of open source alternatives. The technology is being commoditized. That means pricing pressure. That means lower margins. That means the massive infrastructure investments won't generate the monopoly profits that justify them. Fifth, the energy costs are unsustainable. AI models consume enormous electricity. Microsoft recently signed deals to reopen nuclear power plants to supply energy for AI data centers. Google is building dedicated energy infrastructure. Meta is purchasing renewable energy at scale. The energy cost per AI query is 10 to 100x higher than a traditional search query. That cost structure limits profitability and scalability. These 5 factors, high costs, slow enterprise adoption, no killer app, commoditization, and energy constraints, mean AI revenue will grow slower than AI spending. And when spending grows faster than revenue for an extended period, investors eventually notice. Valuations get questioned, stock prices correct, the bubble deflates. Now let me show you the billionaire response because they see this developing. Bill Gates reduced Microsoft from 28% of his portfolio to 13%, a 55% reduction. He's not betting against AI as a technology. He's betting that Microsoft's stock price already reflects overly optimistic AI revenue assumptions. When reality disappoints, the stock will fall. He's selling before that happens. Jeff Bezos sold $8.5 billion of Amazon in 9 days. Amazon stock is priced for AWS, continuing to grow at 20-30% annually. But AWS growth is decelerating, and AI revenue isn't offsetting that deceleration. Bezos knows Amazon's fundamentals don't justify current valuations when you account for the CapEx explosion without proportional revenue growth. So he sold. Mark Zuckerberg sold $500 million of Meta stock. Meta is spending $35 billion annually on infrastructure with minimal AI revenue. The company's valuation depends on investors believing that spending will eventually pay off. Zuckerberg, the CEO, is selling. That tells you he doesn't believe the ROI will materialize as quickly as the market expects. The pattern is clear. Big tech insiders are selling while AI hype keeps valuations elevated. They're liquidating before the market realizes that $200 billion in spending isn't generating sufficient returns. This is front-running the deflation of the AI bubble. Now let me show you the historical precedent because we've seen this movie before. The dot-com bubble. Companies spent tens of billions building internet infrastructure, fiber optic networks, data centers, server farms. Everyone believed the internet would revolutionize business. And it did, eventually. But not fast enough to justify the valuations of 1999-2000. When revenue disappointed, when cash burn became unsustainable, when investors realized the profits weren't coming, the bubble popped. Cisco, the infrastructure provider, fell 89%. Amazon fell 95%. Pets.com went bankrupt. Hundreds of companies disappeared. The technology was real. The infrastructure was built. But the revenue timeline was wrong. Investors assumed 2 to 3 years to profitability. Reality was 10-15 years. AI is following the same pattern. The technology is real, the infrastructure is being built. But the revenue timeline is wrong. Investors assume AI will generate massive revenue by 2025, 2026. Reality is probably 2030, 2035. That 10-year gap is where the bubble lives. And when investors realize the gap exists, valuations collapse. The blockchain bubble is another example. 2017, 2018, companies raised billions for blockchain projects. Every company added blockchain to their business description. Stock prices soared. But the technology didn't generate revenue. The use cases were limited. The killer app never materialized. By 2019, the bubble had deflated. Bitcoin fell 84%. Blockchain stocks collapsed. The technology survived, but the inflated valuations didn't. AI is at the same inflection point. The technology will survive, but the inflated valuations won't. Companies spending $200 billion on AI infrastructure while generating $5 to $10 billion in AI revenue are fundamentally overvalued. When the market recognizes this, the correction will be severe. Now let me show you the timeline because this isn't a distant event. Q4 2024 and Q1 2025 earnings reports are critical. Investors will scrutinize AI revenue. They'll ask about ROI on the massive capex. They'll demand clarity on when AI becomes profitable at scale. If management teams can't provide convincing answers, if revenue disappoints, if margins compress, the selling begins. Big tech stocks are priced for perfection. Microsoft at 33 times earnings, Amazon at 50 times, Google at 27 times, Meta at 28 times. These valuations assume AI will drive significant revenue growth. If AI revenue disappoints, if growth decelerates, if margins don't improve, these stocks fall 30-40%. And they represent 32% of the S&P 500. When they fall, the entire index falls. The billionaires are positioning ahead of this. They're not waiting for earnings disappointments. They're not waiting for revenue to miss. They're selling now while valuations are still elevated by AI hype. And when the hype fades, when reality becomes undeniable, they'll have cash to buy back at lower prices. Here's what you need to understand. AI is real technology with real potential. But real potential doesn't mean immediate profitability. The gap between this technology is impressive and this technology generates sufficient revenue to justify $200 billion in spending is enormous. And we're currently in that gap. Well, the AI bubble isn't about whether AI works. It's about whether AI generates returns fast enough to justify current valuations. And the answer, based on current revenue data, is no. The spending is too high. The revenue is too low. The timeline is too long, and the billionaires are selling before the market realizes it. What should you do? First, reduce exposure to big tech stocks that are overweight AI spending. Microsoft, Amazon, Google, Meta. These companies are spending tens of billions on AI infrastructure with uncertain returns. If you own them, consider reducing positions. Not to zero, but to levels where a 30-40% correction doesn't destroy your portfolio. Second, avoid pure play AI stocks entirely. Companies whose entire business model depends on AI adoption. Startups. Unprofitable AI software companies. These will be destroyed when the bubble pops. Their valuations are based on hopes and narratives, not cash flow. Third, wait for the correction. When big tech stocks fall 30-40%, when AI companies get hammered, when valuations reset to reasonable levels, that's when you buy. Not now. Not while the bubble is inflating. Wait for the deflation. Then deploy capital. Fourth, understand that AI will be important long term. This isn't about AI failing as a technology. This is about AI being overhyped in the short term. The internet bubble popped in 2000, but Amazon and Google survived and thrived long term. AI will do the same, but you don't want to own inflated valuations during the correction. The $200 billion AI bubble is deflating, not all at once, gradually as revenue disappoints. As investors ask hard questions about ROI, as the gap between spending and returns becomes undeniable, the billionaires see it. They're selling. Gates reducing Microsoft, Bezos selling Amazon, Zuckerberg liquidating Meta. They're not betting against AI. They're betting against the inflated valuations that AI hype has created. The bubble will pop, maybe Q1 2025, maybe Q2, but soon. And when it does, so the stocks that led the market higher will lead it lower. The AI narrative will shift from revolutionary technology to overhyped spending, and the wealth destruction will be substantial for anyone still holding at current prices. The warning has been delivered. $200 billion spent, low billions in revenue. The math doesn't work. The billionaires are selling. The only question is whether you'll exit before the bubble pops or whether you'll hold through the correction hoping AI revenue magically accelerates. Because it won't. Not fast enough, not at the scale needed, not in the timeline the market expects. The bubble is deflating. The question is whether you're positioned for it.